The Nasdaq is plunging, leading U.S. stocks lower as Chinese-based AI company DeepSeek sends shockwaves across the U.S. tech sector. We have Barry Bannister, the chief equity strategist over at Stifel. So Barry, we have this huge tech sell-off today driven by these AI fears. We're heading into the thick of earnings season. So how do you think this changes the calculus for this earnings season, especially when we think of things like CapEx spend and margins for a lot of these hyperscalers and chip giants?
Well, to an extent, capital spending creates earnings, right? So if one company spends money, it's earnings to the other company, and that's what's happened with semiconductors. So the other thing to consider is that I know bottom-up analyst, I was one for almost 25 years. Bottom-up analysts focus on earnings. They don't focus on the market and the macro factors. But about 15 years ago, I switched over this new role, and I'm entirely focused on the macro now. And so when I look at interest rates and treasury yields and Fed policy, it's making those price earnings multiples accorded to those earnings very speculative.
So Barry, does that tell us that maybe we've seen a top?
Yeah, I think the S&P 500 topped there in the low 6,000, 6,100 or so. It pulls back to about 5,500 by the end of the year, and it'll be volatile in the first quarter on the way down. Our bigger concern in the second half of the year is the economy. You know, if we have no landing, then yields have to go up. You get what's called a bear steepener in the yield curve, where short rates are held high and long rates rise. The other option is if you don't have the no landing scenario, it increasingly looks to us like a slowdown in the back half. Economic slowdowns, mid to late cycle slowdowns. We had 3 between 2008 and 2020. They're very normal, and that would lead to a 10% correction of the S&P down to that 5,500 level.
You mentioned yields, and I want to pick up on that point because we're seeing this flight to safety this morning. Yields were down as much as 12 basis points. We're now trading slightly above 4.5%, but still the lowest level in over a month. Does this signal the return of this inverse correlation between stocks and yields, which we haven't seen for quite a minute here?
Well, so much of that inverse correlation that we had seen was when we had the positive correlation, I should say, it was due to deflation fears in terms of prices and of bonds and stocks. But what I'm not really fearful of deflation. What I'm thinking is that for instance, the MOVE index, the Merrill Lynch Volatility Index for the bond market. If you look at a 200-day moving average of that index, the MOVE index, and compare it to a 200-day moving average of the 10-year Treasury yield, it's much more typical in the last 35 plus years for the move to peak before, not after, but before there is a peak in yields. I don't think we've seen the peak in yields, and in a no landing scenario, a 5% handle on the Treasury would send this market down.
But Barry, I guess the question though is the markets have very much looked past the surge that we have seen in yields. So what is going to make it different that time around or the next time?
Well, we looked at, valuation is interesting because one, it only really tells you about long-term return potential, and two, it only really matters at extremes. So extreme lows like 2009, you were able to pick up the stock market for 10, 11 times earnings. It was just a bargain at the financial crisis low. Similarly, we looked at the long-term trend of PE on 10-year average inflation-adjusted operating earnings, or its proxy equivalent for operating earnings. This is a Shiller-Cape ratio, except we use a proxy for operating, not GAAP earnings. The bottom line is that this was the 5th mania, or bubble, if you will, in the last 150 years. Stocks are simply extraordinarily expensive, and cash-laden, post-COVID investors simply ignored the risk of paying too much. And as we all know from any real estate or other things we've bought, paying too much is not a good thing.
So you mentioned valuation, stocks incredibly expensive. So what we're seeing at the NASDAQ, S&P, is this a necessary correction? And how do you view that playing out through the rest of this year?
Well, yes, it's necessary in the sense that it's breaking some of the market psychology. For example, the AI companies were committing the mistake that AI always, or any other tech company or any other company makes, and that is they were taking very high monopolistic cash flows and redeploying it into a more competitive, low return business. There just seems to be no end to M&A among corporate finance planning people at corporations, but it's a bad move. And with the China model on the AI, probably useful for 90% of AI applications, we are going to see a competitive market for AI. So there was too much exuberance, and that exuberance is being let out of the market. So yeah, it is healthy.
Barry, when we talk about the shift, maybe that is going on. If we have seen a top, if we do see some more selling pressure across the board, where does that leave that value versus growth trade? And could we maybe see some investment opportunity within value?
Our bigger concern as we look at the back half of the year is an economic slowing. Wages respond with a great lag to policy. And so wages are decelerating at the same time inflation is proving very sticky, which has been our view for quite a while. And now it's a little more consensus. So with sticky inflation and declining wages, what happens is your buying power as a consumer after inflation starts to go down. Add to that the volatility I expect of the first year of the Trump administration. They're in a great hurry before the midterms. They've got to do everything in the first 2 years. That's going to cause a slowdown in GDP in the back half and contribute to a more than 10% correction in the S&P 500. So I do think we'll finish this year around 5,500 in a healthy correction, and then we'll have to start looking at 2026.
All right, and we will talk to you maybe about what that holds soon. Barry Bannister, always great to get your insight. Thanks so much.